Welcome, MHP Rhino Nation, to another episode. Let's get dive deep into MHP's baby.
Yeah.
Okay, so have you ever been there? You're maybe scrolling online, right? You've heard about some interesting investment, maybe something like mobile home parks, and you do a quick search, and boom, the prices you see just make you want to throw your hands up.
Oh, absolutely.
Your brain just screams, nope, way too expensive, overpriced. That ship has sailed. It's a really common feeling, isn't it? That sort of instant discouragement.
It really is. And you know, that feeling for a lot of people, it just comes from a very surface level glance.
Yeah.
Often just quickly looking at online listings leads to what we kind of call the lazy conclusion.
Lazy conclusion. I like that.
But today, here on the deep dive, we're going to challenge that initial reaction. We're focusing specifically on mobile home park investing. And our mission, really, for you listening, is to get past those snap judgments. We're going to try and look at this, well, scientifically, using the insights we've gathered to, dismantle some common ideas about whether these parks are really overpriced.
Exactly. That's what we're aiming for, to kind of peel back the layers on that sticker shock and see what's actually happening with market dynamics. We've pulled together a bunch of insights that honestly challenge a lot of the conventional wisdom you might have about mobile home park investing. So think of this as like your shortcut to understanding this space, which for many people feels, well, kind of mysterious or based on flawed assumptions. So if overpriced isn't just this gut feeling, what does it actually mean? From an investor's point of view, how do we, measure it?
That's a great question. Because that's precisely where that flawed conclusion often starts, right? Someone looks at a listing, sees a big number, and the immediate thought is, they're asking way, way too much, more than it's worth.
Yeah.
It's just a gut reaction, a feeling you get from that, like you said, surface level look.
Right.
But for, smart investors, overpriced isn't really an emotion. It's a specific financial state. It's measurable.
Okay, so it's not just about the asking price itself, but how that price relates to the income and, crucially, the financing costs. That's a distinction I think a lot of us miss initially. Can you break down how we actually define overpriced then?
Yeah, absolutely. What we're really looking at, financially speaking, is the relationship, the spread between the interest rate on your loan and the cap rate of the property. Now, for anyone maybe a bit newer to this, the cap rate, capitalization rate, it's basically the property's annual net operating income divided by its current market value. Puts it simply, it's the return you'd expect if you paid all cash.
Got it.
Now, a market is truly overpriced when those cap rates are actually lower than the interest rates you'd pay on a loan. That means the money you borrow costs you more than the property itself is earning on its own. That's negative leverage. It's bad news. Oh, okay. So the flip side is, when your cap rate is higher than your interest rate, that's good. It means the property's earning more relative to its price than what your loan costs you. And that difference, that positive spread, actually juices your overall return. The loan works for you.
Exactly. That's the critical insight. That positive spread gives you leverage working in your favor.
Okay, let's maybe make this concrete with an example, because I remember times when markets were genuinely overpriced, and it was, pretty painful. Thinking back to, say, the mid-2000s, right before the Great Recession hit, that was definitely a time when investors were buying parks with leverage working against them. The financing cost more than the property generated.
Precisely. That era, you had, easy credit, appraisals were sometimes inflated, and frankly, there wasn't much discipline from lenders. It meant people could get loans even when the basic economics, the cap rate versus the interest rate, just didn't stack up.
The math didn't work. The math just didn't work. Their returns weren't just low, they were, like you said, amplified into the red. It was a really clear, real-world example of a truly overpriced market, where the numbers just didn't support the deal, but the market let it happen anyway.
That's a really stark contrast. But how do we know today isn't just another bubble, maybe a quieter one?
Yeah.
Like, what's really different now compared to that mid-2000s mess?
That's the crucial difference. Today, the situation is fundamentally different. If you look at pretty much any mobile home park deal that actually closes now, you are going to find a healthy relationship. The cap rate is higher than the interest rate. And it's not just by chance. It's baked into the system now.
How so?
Simple. Modern lenders, well, they aren't suicidal. They learn lessons. They are incredibly rigid in their underwriting. They scrutinize everything, the income, the expenses, the projections. And that strict process, that's what keeps the industry, by and large, correctly priced. It forces deals to make financial sense before they get funded. It acts as a built-in brake against that kind of widespread overpricing we saw before.
Wow, okay. So even though a quick online search might show high asking prices, the deals that actually get done, thanks to the lenders, have sound economics underneath. That kind of flips the script.
It really does.
It suggests the market itself isn't fundamentally broken or overpriced in the way it closes. But, all right, if the underlying economics are generally sound on closed deals, then why does it feel like all the good opportunities are gone? Why do so many of us get that impression? Are we just looking in the wrong spots or maybe not putting in enough grunt work?
That's exactly it. I think that perception of scarcity often boils down to, frankly, flawed sourcing strategies. This is absolutely not a lazy person's industry.
Right.
If your entire strategy is just scrolling through online listings, LoopNet, mobile home park store, you're fishing in a very small, very public pond. It's been picked over. You're kind of just hoping someone mispriced something badly.
Yeah, basically waiting for a mistake.
Right. And that limited passive approach, it naturally makes it seem like deals are super scarce. But really, you're just not looking where the real opportunities tend to surface.
I get it. So the real barrier to entry isn't just money or knowing cap rates. It's the willingness to do the actual legwork. The barrier appears when you decide to put in the effort.
Precisely. And that brings us to let's call them the 3 pillars of effective deal sourcing in this space. These are the methods that uncover the deals that don't just pop up online for everyone. We're talking about 1, cold calling, 2, direct mail, and 3, earning pocket listings from brokers. These are the pathways.
Okay, let's tackle cold calling first. That phrase alone probably makes some people listening break out in a cold sweat. It sounds intense, but you're saying it's effective. And it's not just buying some generic list, right? It's about building your own list.
Yeah, you have to assemble your own list. You go to public tax assessor databases, figure out who owns which parks. It takes time. And then, the hard part for many, you got to get out of your comfort zone and actually contact them directly.
Okay, any tips for getting over that fear? What do you even say to someone who isn't expecting your call at all?
Yeah, it's definitely a hurdle. The key, I think, is not to sound like a pushy salesperson. Be curious, be helpful, maybe start with something simple like, hi, my name's your name, I see you on Park Name, I'm an investor active in the area, and I was just wondering if you'd ever thought about selling or maybe know someone else who might be.
Honestly, a lot of owners are actually kind of flattered someone took the time to find them specifically.
Yeah.
Think about it. 99% of potential buyers just scroll past ads. That call puts you in the 1% taking real action.
That makes sense. Frame it as an inquiry, not a hard sell. Okay, so if cold calling still feels like too much, there's direct mail, often seen as, less intimidating, a bit softer. But like you said, less scary doesn't mean less effort, right? You still got to put in the work. Crafting letters, targeting owners, sending them out consistently. What makes direct mail actually work in this business? Consistency and personalization, even when you're doing volume. It's like email, right?
Yeah.
You instantly delete junk. Direct mail needs a hook. And rhythm. It's not just sending one letter and hoping. That almost never works. You need a campaign. Multiple letters, maybe spaced out over time, reinforcing your interest, making a clear offer. And little things matter. Don't make it look like obvious junk mail. Maybe a handwritten envelope address, a slightly more personal tone. It boosts response rates. It's definitely a numbers game, and it requires sticking with it.
Right. Persistence again. Okay, pillar number 3. Pocket listings. These sound like the hidden treasure. Private, unadvertised deals that brokers keep kind of close to their chest. They don't just put these online. You said you have to earn them. By talking to brokers, and there are, over 100 mobile home park brokers in the U.S., and earning their respect. What does earning respect actually look like?
Earning a broker's respect, it boils down to being professional. Simple as that. It means having your financial ducks in a row. You need proof of funds ready. You need to be clear about exactly what you're looking for, your criteria. And ideally, you have a reputation or you build one for closing deals efficiently, not messing around. Brokers, their time is money. They're selective. They only show those private deals to buyers they believe are serious, capable, and won't waste their time or flake out at the last minute.
So it comes back to effort and seriousness again. You prove you're worth their time and their best deals by being professional, responsive, decisive.
Exactly. Answer their calls, make decisions quickly, follow through. It builds trust.
Okay, so let's connect this back. For everyone listening who still thinks, okay, maybe, but surely all the good deals are gone by now, let's hit them with some numbers. Because this part, I think, is really eye-opening. There are roughly, 44,000 mobile home parks across the United States, give or take.
Yeah, around that number, 44,000.
Now, get this. Less than 4,000 of those parks are owned by the top 100 biggest players, the institutional investors.
Think about that. less than 10%.
That's way more fragmented than I would have guessed.
It's a massive implication. It tells you the market is absolutely not saturated by big corporations or huge funds. The overwhelming majority, over 40,000 parks, are still owned by smaller private individuals or families. Mom and pop operators, people who've maybe owned it for decades, local business folks.
So what does that fragmentation mean for me as an individual trying to get into this? Does it mean I should target smaller parks? Or look for specific types of sellers?
It means the supply is definitely still out there. Opportunities are plentiful if you know how and where to look using those methods we talked about. Often, the reason the big institutions don't own more is because many parks are just too small for their investment mandates, or they need more hands-on management than a big company wants to deal with. So it's not like all the easy wins were snapped up by giants. It's highly fragmented, which means for you, the individual investor, you're often competing against other smaller players, not giant funds. You're searching for those hidden gems owned by people who might be ready to retire or who just lack the capital or maybe the desire to really optimize the park. Those are your targets.
This really brings it all together then. Yeah. The core message here, the thing we really want you to take away, is that this is not a get-rich-quick kind of deal.
Not at all.
It's not about stumbling onto some secret or magic formula. It's really about, well, effort, strategy, and putting in the time consistently. It seems like success isn't guaranteed for the smartest person, but maybe for the most persistent and strategic one.
Absolutely. And it's funny, it's really just like going to the gym. You wouldn't expect to get buff or lose a bunch of weight by showing up once a year, would you?
No, definitely not.
It sounds absurd when you put it that way. You have to put in consistent, focused effort, day after day, week after week. That discipline, showing up, doing the work, pushing yourself. Yeah. That's what gets results at the gym, right? You build strength, you see changes.
Yeah.
And it's that exact same kind of consistent, focused effort, making the calls, sending the letters, building the broker relationships that pays off in mobile home park investing.
That's a great analogy. Really lands the point. It's the grind, the steady effort that yields the results. So let's wrap this deep dive up. Let's answer that initial question definitively. Based on everything we've explored today, the answer seems to be a pretty clear no. Mobile home parks, as a category, are not fundamentally overpriced in the way smart investors define it. And no, all the great deals are not gone.
But, and this is a big but, you absolutely have to put in the real effort to find them and get them. They are not just going to fall into your lap.
Right. So maybe a final thought for everyone listening. Think about where else in your life, or maybe in other investments or business ideas, you might be holding back on effort. How often do we avoid the hard stuff, the cold calls, the consistent outreach, the really deep research, just because it seems too hard or, not glamorous enough? Sometimes just identifying those effort barriers in any complex area, not just mobile home parks, can actually point you towards the most rewarding paths, the ones that aren't so crowded. What opportunities might you be missing just because they require a bit more elbow grease than you're currently putting in? Something to chew on.
Well said. Until next time, keep digging deeper.